Big picture analysis, U.S. stock market, March 18th, 2021. So I waited to do a big picture analysis on the stock market until we got past this mid-March period. We had looked for the market to correct into mid-March, and I wanted to wait and see what that looked like before doing anything where I'm looking at the big picture again. And the stock market continues to make new highs now as investors continue to remain confident that Fed liquidity and government stimulus is going to remain in effect. We saw the FOMC news come out, and if anything, they were more dovish than they were before. In the corrective period that we were looking for, we saw very positive intermediate patterns bring only modest corrections. The indexes fell in the time frame that we looked at, but the S&P 500 fell only 5.7%. The Russell fell 11.2%, and the NASDAQ about 12%. So most of that was in line. NASDAQ exactly tagged the levels that we were looking for on the downside. But the overall patterns remain extremely strong. And now we're in a period of a huge rotation in the stock market as money moves out of the techs and the stay-at-home stocks, work-at-home stocks, into the stocks that are recovery stocks, the ones that will benefit from an increase in GDP and things getting back to normal, and things that were of value that look cheap to investors, and they've been moving into those also. The consequence is that we've seen a net effect of still higher prices, but the NASDAQ underperforming the market and the Russell significantly strong, moving up and overperforming. And then the Dow, which I don't look at a lot, has done extremely well, as a lot of those value stocks are in that category. And what we're looking at, we have estimated based on patterns, would continue out into the spring, looking at higher prices. But then after that, we believe that risks will grow significantly for the stock market, and that a far more severe corrective period will show up sometime in this year, probably sometime in the summer. We're going to look at that. I'm going to do this analysis looking at multiple time frames, as we always do. The cycle analysis that we bring, for those of you that are new, is a way to look at money flow. The longer the pattern we look at, the more dominant. So if we're looking at a monthly chart, those are going to be very long-term holders. Those are people that put money into the markets for long periods of time and are reluctant to sell. Those become very dominant. That's a big battleship that's kind of hard to turn. As you come down in time frames, essentially you have shorter holders of shorter duration, and they are less dominant in the patterns. In other words, the money flow in a daily chart is far less important to the overall longer term movement than the weekly or the monthly is. So we're going to look at three different time frames in here. We're going to look at the quarterly cycle patterns. We're going to look at the monthly cycle patterns, and we're going to look at the weekly cycle patterns also. 8 different charts that we're going to look at. We assume it's going to take about 30-35 minutes to do so, and that is going to give you some information I think you're going to find extremely useful here as you plan out your longer term holdings and as you look at the potential for some significant trades in one direction or the other, of course. So we're going to start this out by looking at the quarterly chart. Now, I've shown this chart in, I believe, 2 other big picture analysis videos. And I think it's very, very important because, again, as we say, dominant patterns are in the longer time frame. So we're looking at a chart here, and I'm going to show you about 100 years of trading, where the average cycle on these quarterly charts is 28 quarters. It's about 7 years. Now remember, the principle of variation suggests that it will vary by several quarters one way or another. So the cyclical rhythms, or the periods in each of these cycle patterns, are not consistent. They have an average time frame, and you'll see how some of them are spot on where the corrective periods come, and some of them are off by a little bit, but I still think you're going to find it extremely interesting. So what we're looking at here are the Roaring 20s. Yes, that was 100 years ago, where stocks had a 600% gain, and that was off of the mini depression that occurred that ended in 2021. Jim Grant wrote a great book about that depression, and I think it's one that is very worth reading because it was so short because the Fed did nothing, essentially. The government did nothing. Of course, the Fed was brand new at that time, and they more understood their role than I think that they do right now. And they just simply stood aside, and that depression ended quickly. And then we got back into the Roaring 20s. But then they really lowered interest rates. There was a huge technological expansion, mass production of goods, and the electrification of America. All of that brought the Roaring 20s, and we saw the 600-point gain, followed by a crash that wiped the market out of about a 90% loss in 1929. This is the key low in here that we're working off of, and this is the cycle pattern right in here that averages 28 quarters, 7 years in length. And as we move forward, I'll do it a little more quickly, and you'll get a pretty good sense. I have a lot of notes in here that will give you a sense for what was moving the markets at the time. I don't want to spend a lot of time on that. What I'm most concerned about is you seeing the rhythms in the market in here. As you see here, after the post-war boom right in here into the 50s, you had that low that came right in there, right on the 7 years. So these vertical lines are where I'm putting in the actual lows on the cycle, and then you will see the how that plays out. So you had the low over here after the crash of 29 in 1946 over here. You had the next one over here about 7 years later, and the next one over here almost exactly 7 years later. Now you'll see how these things line up very, very nicely as we move forward. Here is the next low right over here, and we're looking at the period where we get into the 60s and 70s right here. Here's the low in 1960. It was kind of equaled over here and by the mini crash in 1962. Here's your low right over here in 1969. That was the 68 peak. This is the 60s and 70s where you had that big triangle, and you can see the bear market and energy crisis here in 1974 and 5 made that very significant low spot on the money on that 7-year cycle. So 7-year cycle low right over here, 7-year cycle low right over here in that nice megaphone, and then the 7-year cycle low over here at the really famous 82 low. This was the Volcker inflation battle here, as rates go from 10 to 20%, and they peaked in 1980. So you can see that beautiful cyclical pattern as it continues to give you these bottoms that are approximately 7 years apart, 28 quarters. So now we're going to come a little bit closer in here, and we're going to look at this period right in here. So this is the crash of 87 that occurred. There's the low right over there in 82 we're talking about. Here's the crash of 87, almost, very close to on the money here on this cyclical pattern that you see right over there. And then what happened after that? Well, you had the great bond market massacre of 1994, which only brought the market down a little bit here when you're looking at the Dow Jones from 4,000 down to about 3,500. So that wasn't that big of a decline when you look at that there. So there was the crash of 87. There was the great bond massacre. And now we're going to have to tighten this up again for you to see these other patterns as they come in right here. So I have to bring this way, way down in here. And now let's look at what's happened since that 1987 crash into this time frame of where we are right now. So again, here is that great bond market crash. This is the low here. Here's your tech bubble, the long-term capital crisis there, and the great dot-com bust that came right in here. And you can see where that low came. Here was where the ideal 7-year cycle was. Here's the Greenspan bubble here. So you had the tech bubble, the Greenspan bubble right in here. The financial crisis, look where it bottoms, right here on that 7-year cycle. Here is the Bernanke-Yellen bubble right in here, which really continued into the Powell COVID bubble. Here's the mini bear, bottoms almost right exactly on the 7 years. You can see that. And that brings us to where we are right now. And this is important when you look at this. So this is the period of the great Fed, a great experiment, the activist Fed, and the period that we're in now, which is really a period of MMT, where the magic money tree of modern monetary theory brings you to this crazy period that we're in right now. The Powell COVID-19 debt bubble that essentially brings you NFTs and cryptocurrencies and specs and SPACs and all of this period that we're in right now. So when you look at that, you see that this is where the mini bear bottomed right in here. Again, we're looking at this 28-quarter period in here. And now you can see, pointing out to here, these are the time frames for the next 28-quarter low, plus or minus a few quarters right in here, coming out into 2023. So it could bottom in 2022. It could bottom late in 2023 right over here. And there is an expectation of some significant decline, which begins sometime this year and then starts to come down into sometime next year or potentially into 2023. So that's a look at all of these quarterly cycles that you see right in here. I'll just get a picture of them right in here, just these last 5 cycles, and how they line up so unbelievably well. Remember, the vertical line is the actual low, and the cycle bracket is the 28-quarter low, and you can see how that lines up. There is a very significant decline and low coming out into 2022 or 2023. So that's a look at the quarterly cycles, pointing to a lot of trouble coming later this year and into next year. So now let's take a look at the monthly charts, and we're going to break this down a little bit more so that you can see where we are and why there's a period ahead that has some significant risk. So moving in right now, this monthly chart right over here of the S&P 500, and what we're looking at here are cyclical patterns. Let me just clear this up a little bit and bring in the monthly. There you go, clean that up. Okay, so what we're looking at are the monthly patterns right in here of the S&P 500, and the cycle harmonics that are in here are 76 months. It's actually 38 months, yes, and 19 months. That's this big cycle right over here is 76 months. The minor one, and you can see the clarity in there, is 38 months, and that's the intermediate, and the minor one is 19 months. And look at the beautiful cyclicality that you see in here. So each of these 3 stars are where 3 cycles come down and bottom, and you get big bear market, big bear market. Only a 16% mini bear in that one right over there, and the next one lined up to come here, yes, in 2022. That means there is a significant decline coming in the market into 2022. These bears were 51%, 55%, only 16%. And when you look at this megaphone and the fact that it's had all of these cyclical patterns that came up so far, from a price in the S&P 500 of way down over here at 66, all the way up to where it is up here, like a 7 times gain, 700%, you know that the coming decline is going to be pretty significant. Let's look only at this cycle right over here, and you can see that we have been projecting up on this monthly cycle, and that has been correct. It moved up through that 39.06 level from that March 20 low, and then it's projecting up over here into the areas of into the 4100s, potentially 4200s on the monthly chart. So there is some period ahead that the market could still do well, but then we get into significant period of risk. The average bear market is over 30% on the downside in about 13 or 14 months. That's basically what we have projected in here. If you look at 30% bear on the S&P 500, if it were to fall right now, it would get down to about 2760, about 1,200 points on the S&P 500 to just make the average bear. Of course, we're looking for it to get higher first so that these numbers will come up, but the probabilities are extremely high based on what we're looking at here. And remember, we're getting into this period of 3 cycles in here that will be pointing to the downside as it did in these other markets. And when 3 cycles point to the downside, you get big bears, as you see right in there, and that's where we are coming into this right now. So we had the mini cycle, the minor cycle in here, bottom on that COVID crisis, and came right back up. As you can see, we know that was a very quick return. And now we're making the peak of 1, 2, and 3 cycles over here sometime in the next few months is what I would say. And then we get into this period of significant decline. This decline will be joining that 28-quarter decline that I just showed you, and that brings the potential for a very significant declining market. Now, you figure the Fed would never let that happen, but it's not going to be in control of the Fed. And it could be just the slightest whiff of the change of policy and the markets head down. There is a possibility that this holds up longer, and that would just make the decline steeper, more crash-like. The longer this holds up in here, I'm talking about maybe May, June, July that it could hold up to in here. The longer it holds up, the steeper the decline, and likely the shorter the duration of the decline. So we don't know for sure how that's going to turn out, but the probabilities are extremely high that we will see sometime around mid-year the peak by that time, and that we will be entering a bear market at that point based on the quarterly cycles, based on the monthly cycles. When I look at the NASDAQ, we'll just take a peek here at the NASDAQ. It's basically the same pattern. You could see in here that great experiment that we've been in and what it's done, moving the market up from 1,000 to 14,000, almost 14,000. And the same harmonics in here, the same look at a decline that is likely to begin. Now, this one actually looks like it started already to me. And with these, kind of a tweezer top or high waves, that really looks like the NASDAQ top is pretty much in place. Now, I'm going to show you a weekly chart, and that is going to show you that it's possible that we test the highs, maybe take it out by a little bit, but then we get into this declining period, and we would expect the bear to be at least 30%, taking you under 10,000 in here, depending on if we make a higher high or not. So being that I don't really expect the NASDAQ to make much of a higher high, it's reasonable to project down to this area of about 9,700 in the NASDAQ by sometime in 2022. And again, this kind of comes out to sometime around sometime early 22 to mid 22 where those bottoms shape up. So that's a look at the NASDAQ and the S&P 500 on the monthly charts, both pointing to a severe decline coming into 2022, and we'll just call it the average bear, around 30%. So now I'm going to bring a chart that I only showed once before, and I'm going to show it again, and that is a relative strength look at SPY, and I think you're going to find this extremely interesting. So what we're looking at here is a disparity index, and this is set up on a monthly chart. So it's a 13-month disparity index. And what we're looking at are the extreme distances. How far does it get from the 13-month moving average? Now, this is the slim ribbon. And the slim ribbon has been in bullish configuration from this point right over here, which is all the way back to 2010. And it right over here gave you a little wiggle and to neutral, and then came right back to bullish. And even through this March decline, it stayed bullish. Now, what we're focusing on here are overbought, oversold conditions. During this period over here in 2009, you could see it got down as deep as 30% below the 13-month moving average. Here it got down in the after the 2000 and the dot bomb break to about 20% underneath that moving average. So these were real panics on the downside, as you can see. This mini bear over here only got down to this level here, which was about maybe 5.5% below that moving average. It was a very, very strong market. Now, the key things that we want to look at is how much overbought does it get before you get into significant corrections. At this point, where the 2008 peak came, it got up here to approximately 9% over that moving average. Here you could see before this was the period of the Euro crisis right in here, and before it went into that correction, it got up to about 12.5% above that moving average. Here you could see it managed a few times without any significant corrections to get back up into that level. That's a pretty unique situation, and it shows you the strength of the market over there. But now you can see we are getting up to records right over here. This is the highest point of overbought condition of over 14% above the moving average that the S&P 500 has seen in all this period. This shows an amazingly huge overbought condition and is setting up for a very, very large return back to below that 13-month moving average over there. That's not a huge decline, but by the time this bear market comes, you're probably going to get down to 20% below it over here. So we are just now getting to a period of an extreme overbought condition that it has really never seen before. It got up over here to a similar level, about almost 14, and then you had this break right over here, and then the market, of course, recovered. So we're at record overbought conditions in the S&P 500 as we look at that, and that is meaningful when we see that. So now I'm going to show you another very unusual chart as we switch over now, and I'm bringing in a chart of the Nasdaq in here as it relates to Russell. Now, why is this important? Well, right now we have a situation where the Nasdaq is grossly underperforming the Russell. What does that mean? Well, it means that we have a situation where the money is flowing out of these Nasdaq stocks and into very, very speculative stocks. I mean, when I look at this, all I can think of is money is moving out of the techs into the specs and SPACs and NFTs and cryptos and all of the most speculative things you can imagine. Now, when have you ever had an extreme situation of the Nasdaq losing ground in a significant way, relative strength to the Russell? In other words, the money from growth into speculation. Well, you had that as the money started to fly out of the techs in the tech bubble right over here, as the stock market was making its high before losing 50% of its value. Look at the crash in here in relative strength of the Nasdaq to the Russell. The Nasdaq just absolutely getting pummeled compared to the Russell, and you have that going on right over here, where the Russell is screaming on the upside, the Nasdaq is faltering, and the relative strength is plunging right now. This shows you a huge change in the market from where we have been, where there's been some consistent gaining in here of the relative strength right over here in the Nasdaq to the Russell, very consistent, and then the Nasdaq exploded against the Russell, relative strength wise, and now it's collapsing right over here as money moves out of the Nasdaq into these speculative situations. This, to me, is one of the giant red flags that we could be seeing, and I think that is a very significant thing to be thinking about as we look at this market situation in here and say what are the risks that we're looking at. And the risks right now are that money is essentially moving out of the stocks that weigh the heaviest in the indexes and moving into some of the most speculative areas. And to me, that is a sign that the market's got lots of problems moving forward. So that's, I think, an important look at something that we're looking at. Again, this is that NASDAQ monthly that we're looking at. I have one more chart here that I think is hiding under here that I want you to see. That's not it. Maybe I don't have it here. Maybe I do. Let's take a look. No, that's not it either. So the other thing I wanted to show, which is a chart that I don't have handy right now, is a chart of the HYG, and I'll show that in some other video. But no, I got it over here. Okay, now I spotted it. This is the HYG right over here. And if you remember that when the Fed was trying to bail everything out, they said they're buying everything, all of the junk bonds. And I want you to see in here, we have the S&P 500 brackets in here. And we have the minor cycles in here lining up with the HYG. So this is high yield bonds. These are essentially corporate junk is what it really is. And look at this resistance level right over here. When the stock market moves down pretty sharply, then what happens is that they also sell these very sharply. And you can see we're in the resistance and stalling no matter how much the government is buying these. And I want you to see that this lines up for this correction right into here, exactly in line with the stock market. So there is a potential, and I think it's important for you to watch HYG or JNK, because if we start to get some significant breaking in that on the downside, you will know that there is some significant trouble in the markets as we look ahead. All right, so now what I want to do is I'm going to step this down into the weekly charts right over here, which I show you all of the time. And this is the NASDAQ. We'll start with the NASDAQ right over here so that you can see. Now, we were looking for this correction into the March period right over here, and we got it. So it was about a 12% decline. People that like to be critics know that I was looking for the top to come over here and expecting it to come down sharper there. But the markets would not oblige because of the massive money printing coming in, and the relative strength and the strength in the market momentum remained very strong, and now momentum is negative here in the NASDAQ. We are projecting for the NASDAQ to get up here and make a double top, right up here at around 13.8. This level here is around 14,250. That is a possibility, and you can see this is only 2 weeks into this rally. And that's, leaves a lot of time. I mean, really, for the rally easily to come out here in the May and June. But then you get this bigger cycle comes down right over here. And this is why I believe that we can get an early top this year rather than it making it to later in the year, because this cycle over here comes down into August. So if we make it high in May, June, comes down sharply into August, and you could see that yellow oval over there as I begin to put in that period of big risk out over there. So we get a decent rally in here still. The market is still okay when we look at this. But that high period comes, I think, out into that period of May or June. Now, if you looked at our Future Speak show recently, we talked about the bond market and that the bond market was likely to stay on the downside till late April, early May. There is a potential, because of the correlations or inverse correlations, that the bond rally, the next rally, which is likely coming in sometime in May, June, July, which will be a recovery rally and a decline in interest rates, may align with this big decline that we're looking at right over here. So we're going to continue to look for kind of a May, June peak here in the stock market when we look at that. For the S&P 500, you can see this one in here. There is a potential for pretty significantly higher prices still in here, as we point to the potential. Again, we're only 2 weeks above this, and then getting up realistically to 4,100. This level here is 41.85, and right over here the bottom of that fib extension is around 43.20. So any of those are possible. and that really is the beginning. We're right now in the beginning of this next rally phase, and again, the big corrective phase comes out over here after this rally, which comes into this July-August period for some significant declines, and may very well be the first wave of the bear market that I think is coming this year out over in that period. So it doesn't look like there's a lot of risk right now. I want you to focus on 37.23. If 37.23 at any time gets broken, it's a long way down from here, that will signify that something has changed and the rally period in here has aborted, and the effect of the longer term patterns is taking over earlier. So right now I don't expect that. It's extremely low probability, but we want to keep our eye on that 37.23 level. That is a very, very significant level. So what we're looking at is a market that still could be pretty good in this time frame here, as we're looking for a rally into the springtime. So the next thing that we're going to look at in here is just a summary. The next thing we'll talk about. What I showed you is are many patterns in here, many longer term patterns that say that there's market risk coming. It's realistic that we get a test of 4,100 on the S&P 500 first, possibly even 4190, 4180. The NASDAQ testing around 13,880 or a little bit higher before there's any real issue. If 37.23 gets broken on the S&P 500, we'll take that as a big warning. So things seem okay between now and sometime in the spring. The risks really pick up in the second half of the year as investors begin to get ahead of the FOMC and their policy changes, and even looking into the 2022 elections. There is a lot of risk coming forward and a lot of things that can unravel this very speculative situation we're in of just a liquidity-based rally as this great experiment has reached just hyperbolic levels, and the Fed just recklessly, in my opinion, printing money, and that has brought all of this speculative fervor that we see in crypto and NFTs and the stock market at 33,000 on the Dow, and Bitcoin, of course, and all of those things that are just incredibly speculative. I showed you how the speculation is just increasing when you looked at that relative strength of the NASDAQ to the Russell. If there's any chart that is striking that I just showed you, it's that on top of the extreme overbought condition we're looking at on a monthly basis that I showed, and all of those add up to a limit to how much the market can rally in time and price. Yes, 3, 4, 5% more on the upside is possible. A couple of months, 3 months still that the market could hold up. I think all of that is possible and all of that is likely. But then we get into our just average bear that is likely to move down into 2022 and potentially 2023, that we think will be 30% decline in the stock market. This speculative surge that we're in needs cleansing, and it is going to come as it comes every 28 quarters that I showed you, and that 28 quarter period is coming. 2022, 2023, the market will have a washout during that period. Nothing is written in stone, but I think it's extremely likely. That is big picture analysis for today, and I'll see you in the next segment.